Welcome. Today we're diving into a powerful approach to investing, one designed to put you in control of your financial future. It's based on the principles laid out in Phil Town's insightful book, Rule Number 1. This isn't about complex jargon or chasing fleeting trends. It's a guide to value investing, simplified and made accessible for anyone ready to take charge. It's about understanding what you own and why you own it. It's about making informed decisions, not speculative bets. The fundamental principle is simple: buy wonderful companies. These are businesses you understand and believe in. Equally important is the second part of the principle: buy these wonderful companies at attractive prices. This is where value is created. The ultimate goal of following these rules is to achieve financial freedom. It's about building a secure future for yourself and your family. A cornerstone of this investment philosophy is truly understanding the underlying business. This goes far beyond just knowing a stock ticker symbol or watching its price fluctuate daily. It means digging into what the company actually does. How does it make money? Who are its customers? What are its challenges and opportunities? This deep understanding is crucial. It allows you to make confident decisions based on the company's reality, not just market sentiment. It distinguishes informed investing from mere speculation. You become an owner of a business, not just a holder of a stock certificate. Following these steps helps eliminate guesswork and emotional decision-making. It provides a repeatable framework for success. The very first step is personal and foundational. It's about defining your personal financial goals. What are you investing for? Think about your desired lifestyle, both now and in the future. How much income will you need? What kind of financial security do you envision? This step is about identifying potential investments, but not just any companies, wonderful companies. Start by looking for businesses you understand. This could be companies whose products or services you use or industries you work in. Find businesses you enjoy or find interesting. Investing should align with your interests to some extent, making the research process more engaging. Identify businesses you genuinely believe will thrive and grow over the long term. This requires looking at their competitive position and future prospects. A key concept here is the moat. This is the competitive advantages a company possesses. A strong moat signifies a company's ability to fend off competitors and protect its profitability over time. It's like a castle's moat, keeping invaders out. Look for companies with strong brands that command customer loyalty and pricing power. Think of iconic names people trust. Consider companies with recurring revenue streams. This provides predictability and stability to their financial performance. Also, look for companies with a history of profitability. Consistent earnings demonstrate a successful business model. A wonderful company is one that is understandable, has a strong competitive advantage, and a proven track record. Once you've found a wonderful company, the next step is valuation. This is where you determine if the company's stock is trading at an attractive price. The sticker price is simply the current market price of the stock. This is what the market is asking for it today. The intrinsic value, however, is the company's true worth based on its fundamentals. It's an estimate of what the business is actually worth. Intrinsic value is typically based on the company's expected future cash flows. What money is the business likely to generate over its lifetime? Rule number 1 provides simple formulas and tools to help you estimate this intrinsic value. You don't need to be a financial wizard. The goal of these calculations is to determine if the company's stock is trading below its estimated true worth. The valuation process focuses on achieving a reasonable annual return on your investment, often targeting around 10% or more. This is the potential growth you're looking for. This final step is critical for successful value investing. You only buy the stock when its market price is significantly below your calculated intrinsic value. This difference between the intrinsic value and the market price creates what's known as a margin of safety. It's a cushion against potential errors in your valuation or unforeseen business challenges. Buying with a margin of safety also allows for potential profit as the market price eventually moves closer to or exceeds the intrinsic value. It's like buying a dollar for 50 cents. This disciplined approach prevents you from overpaying for even the best companies. Price matters. To truly understand a business, you need to go beyond the surface. This involves both quantitative and qualitative analysis. It stresses understanding the numbers, the financial statements. Look at revenue growth, earnings, debt levels, and cash flow. But it also stresses understanding the qualitative aspects of the business. This is about the less tangible factors that contribute to its success. Encourages reading company annual reports and quarterly filings. These documents provide a wealth of information about the company's performance, strategy, and risks. Understanding the management team is vital. Are they competent, ethical, and aligned with shareholder interests? Good leadership is a significant asset. Knowing the company's industry, its competitors, and its place in the market is also part of this deeper understanding. Context is key. It warns specifically against the powerful emotions of fear and greed. These can lead to impulsive and poor investment decisions. Fear can cause you to sell good companies during market downturns, locking in losses. Greed can push you to buy overvalued assets during bubbles. It highlights the dangers of relying on market timing. Trying to predict short-term market movements is incredibly difficult and often leads to mistakes. Instead, the philosophy advocates strongly for a long-term investment perspective. Think in terms of years and decades, not days or weeks. Compounding is often called the eighth wonder of the world for a reason. It's your greatest ally in building long-term wealth. Resisting the urge to constantly trade is crucial. Let your investments grow. It focuses on building a solid foundation for long-term financial security and freedom. It's a marathon, not a sprint. The book simplifies complex financial concepts, making them accessible to everyone, regardless of their background or prior experience. It demystifies investing. By understanding businesses, valuing them correctly, and acting with discipline, you can build significant wealth over time. It's about smart, patient ownership. This journey requires commitment, but the rewards of financial independence are well worth the effort. Start today.